Hello and good afternoon to everyone. Thanks for staying with us all this time and listening to all our guests, including Nick, who just came off. So today, the title of this sharing is Surviving the Yield Chase, Strategies in a Falling Rate Environment. So as we know, the Fed has cut rates a little, and I think if you're interested in income or yield in today's environment, this is the place to be. So we have three speakers today. At the end, we have Colin from iFAST. We also have Nick Tong from T. Rowe Price. And we also have Marcio Borgorison from PIMCO. And they'll share with us their thoughts on income in this falling rate environment. Thank you for having us. Thank you for coming. So maybe I'll kick it off. So last year, the Fed cut rates a few times, and rates are now at 3.5% to 3.75%. So perhaps I'll start with Colin. So was this surprising to you, and what do you expect in 2026?
All right, thanks, Cyrus. And hi, everyone. I'm Colin, and happy to be here and happy to see your familiar faces. So to answer your questions, am I surprised? I think markets in general, and me as well, not really a surprise at all, because I think if you look back at 2024 and even 2025, there are already talks of rate cuts. So I recall earlier, at the start of last year, I think markets are already pricing in 1 to 2 cuts. So in terms of rate cuts, it's not really that surprising. But what is more impressive or interesting is how cautious the Fed were when they approach rate cuts. So for me, it is a bit like easing your foot off the brake pedal, but keeping 2 hands firmly on the wheel. So that is the kind of mentality that was conveyed to me. So in the FOMC, there was a lot of discussion and there was a lot of talks of not cutting aggressively, but in a more gradual approach, making small cuts while looking at how economic data evolves. So I think that mindset carries this year. So we think that in this year, looking forward, we do expect probably 1 to 2 rate cuts, and largely because US labor market is cooling. But if the US economy remains resilient, or the labor market and inflation remains resilient as well, we do think that the Fed will be happy to just sit back and hit the pause button and sit tight. But conversely, if we are expecting the US labor market to see some form of meaningful weakness, we are likely to see more rate cuts. So how much more, I think, is the question here. We do think that the Fed is likely to nudge interest rate closer to what they think is the neutral level, which is around 3%. So we are likely to see 3, 4, or in the worst case scenario, even more rate cuts if the US labor market deteriorates meaningfully. So overall, I think this year is a year of fine-tuning rather than big moves for the Fed in general.
Okay, so maybe for Nick, so if this is a year of fine-tuning, more gradual cuts, so do you agree with this? And if so, should you just hold cash?
Yeah, thanks so much again. So I think our view is that actually we sit on the other side of the fence. So actually, if any of you understand some of our fixed income portfolios, you would already have observed that we have been underweight duration for some time. And actually, our base case for the first half of this year is no cuts. We agree that the base case is still 1 to 2 cuts in the second half of this year, but that will be very much dependent, I think, on who actually is the next Fed chair. And I think the news that's happened the last week or so, and this is still a developing story, right? It's really added volatility to the potential range of outcomes. So you can see that if the criminal charge actually does go ahead with Jerome Powell, that would signal in a very meaningful way to whoever comes in as the next Fed chair that maybe if you cut rates, it will be seen as something that you're doing for the US president. And if it's not the right thing to do for the US economy, would then drive inflation higher, and by extension, some of the longer dated bonds will be negatively impacted. So that's something that we're watching very closely. And I realized over the last week, I've seen quite a lot of news coming out that this is becoming more and more a view that people are watching out for. Maybe not quite everyone's base case. We still think the cuts will happen in the second half, but also an acceleration of some of the fundamentals in the US. The one big beautiful bill that was passed last year actually has added to US fiscal deficits, and now we are looking at 6 to 8% fiscal deficits in the US. For context, right, the amount of money we spent in COVID in Singapore, that amounted to about 5% of Singapore's GDP. Right? So they are running at a yearly 6 to 8% deficit. That's how much they're running at. And with that backdrop, it's already a big question mark on where inflation goes and how much the Fed can then cut.
Interesting. So many factors from the Fed to fiscal policy. So Marcio, what do you think? Do you think gradual cuts are the way to go?
Yeah, so at PIMCO, we agree that we think the Fed will probably cut 2 times in the second half of the year. So that means that you're still getting very attractive yields, very attractive yield with high quality bonds. But the other thing we're looking at is what other countries might be cutting faster than the US. And that has been a very winning strategy for us and our funds. So if you think about countries like the UK or even last year, Australia, because their economy is more sensitive to rates, they had to cut rates faster than the Fed. So if you were holding bonds from those countries, you actually got better performance or you got capital appreciation there. So the way we're thinking is, again, the Fed will cut twice this year, probably in the second half of the year. But we're also looking at the overall opportunity set and how can you develop a global portfolio taking advantage of other central banks that might be cutting rates and not just focusing on the Fed.
Oh, that's really interesting. So opportunities all over the world, not just the US. Perhaps, Marcio, I'll push you a little more. So you mentioned a few countries like Australia, like the UK. So which countries' government bonds are you perhaps more positive on?
Yeah, so right now, the rates in the US are high, right? As it was mentioned, at 3.5 government bond with a little bit of spread, a little bit of alpha, you're looking at a very high quality portfolio of around 6 to 7%. When you look at the global opportunity set in the developed world, we like, as I mentioned, the UK. We've had exposure in the past in Canada and Australia, so these are very high quality. A place that is very interesting right now is Japan. If you buy a Japanese government bond and you hedge it back to US dollar, you're getting almost 6 to 7%. So think about that. Japan giving you 6 to 7%, not too bad for the quality that you're getting there. So really looking more broadly. Emerging markets, for our flagship income fund, we do not do much in emerging markets, but if you want to do emerging markets, you have countries with very high interest rates. So what you're getting there is the carry of that interest rate. So you have a little bit on that portfolio, you can have an attractive yield pickup. So countries like Brazil, Mexico, and Latin America, you have rates that are double digits, and you can have a yield pickup. But we do like the US a lot because, again, rates are high, very liquid market, and you do have different options that you can buy there.
Okay, really interesting. Looks like there's really a lot of opportunities out there. So Nick, what do you think? Are there any countries that you like?
So I would caveat that with we still prefer credit, broadly speaking. But within duration as well as government bonds, we want to be very active. So staying with the US first, we are underweight, similar to what Marcio seems to imply. We have a curve steepener, meaning that we think the front end will slightly get lower, but the long end, given the potential inflation pressures, will stay high to maybe potentially surprise higher. So having that steepening position in the portfolio will allow us to benefit from this curve movement. In developed markets, I think one that Marcio might not have yet said was we also like New Zealand a lot. That's because we actually see the economy there to be slightly weaker than consensus. And we expect that the central bank will have to cut ahead of a lot of what the market is pricing in. And you always want to find an idea which is different to what the market is saying, because that's truly where you will be able to deliver outperformance. We similarly like select emerging markets. I would say we would lean to more the quasi-sovereigns, the ones which are related to some of the state. So to give you an example, Pemex in Mexico, you still get about a couple % more buying the Pemex bond than the equivalent Mexico government bond. But that bond has tightened so much because of a lot of dynamics last year. And the average Pemex bond actually returned about 24% last year. So spreads have tightened very significantly. But at the same time, you can still find a lot of opportunities if you look hard enough from the bottom up. And that is something we truly want to do, to be selective, especially as valuations enter the very tight stages.
Thank you, Nick. So I think you've referenced valuations. So perhaps moving from government bonds to corporate bonds. Nick, how would you approach corporate bonds in this environment where spreads are coming down, yields are coming down? And are there segments you are more positive?
Yeah, so I would say in corporate bond space, in IG generally, we prefer the short to intermediate part of the yield curve. And that's also reflective of our views in the rate side of things. So we think the amount of risk you take with the relatively tight spreads is lowered when you actually use the shorter end of the curve, because then you don't have a very large spread times duration impact if you actually go super long dated in investment grade and the trade moves against you. Generally, we expect a very benign default cycle, but that's something that we are paying close attention to. Within high yield, we actually prefer Euro high yield than US high yield. And that's because we see a lot of potential M&A activity happening in the US, so much more issuance. I think EM I already mentioned. But I just wanted to add two quick ones before I pass the time back. Is that number one, I think it's important to be selective. And I think that being T. Rowe, we are actually very well positioned to be selective, because we run about 325 billion in fixed income assets. And that allows us to be large enough to be able to participate in all the deals you want to, but small enough to stay nimble. The second thing I really want to highlight is attractive yield headline numbers are attractive for a reason. Don't stretch for the sake of stretching. And the example I want to give you, and the reason why I'm sure when you look at our fact sheets or PIMCO's fact sheets, you don't see very much C-rated bonds, is because if you look at the last 20 years, a double B high yield rated bond on average has yielded about 6.8% with an average default of 0.5% a year. You step into single B, that steps up to 8.7% with a 4% default rate. And if you go into the triple Cs, you're looking at the 13 handle, but 1 in 3 bonds default every year on average. So that's a very scary thing. And as investors, you always want to play the right numbers to be able to deliver the best over risk-adjusted return.
Okay, so lots of analysis. I think the important thing is that selectivity is key. So Marcio, within corporate bonds, what do you think?
Yeah, so Nick used to work at PIMCO, so that's why he knows PIMCO so well, and he was talking about our fact sheet. We work together at PIMCO. So in terms of credit, we do not like high yield and investment grade right now. Spreads are very tight. So high yield and investment grade bonds, they are priced for perfection. And fixed income, the upside is limited and the downside can be a lot. So we are very cautious with both investment grade and high yield. What we like a lot right now, especially in the US, are the agency mortgage-backed securities. So let me spend 2 minutes there. So in the US, they have these agencies that are backed by the US government, right? So the US government established these agency mortgages. So what happens is if you get a mortgage in the US and they qualify for an agency mortgage, these agencies in the US, they will put them together and they sell it to investors like PIMCO. The beauty of these mortgages is that they're backed by the agencies which are backed by the US government. So if any of these mortgages default, they replace it with a mortgage, a new mortgage. So as an investor, you have zero credit risk. You have zero default risk, zero. And the only risk you have is people pay their mortgage a little bit faster and you get your money faster, which is called prepayment risk. Historically, corporate bonds paid you a higher yield than agency mortgages, and that makes a lot of sense because corporate bonds, you're taking credit risk, and agency mortgages, you're not. So historically, corporate credit bonds had a higher yield than agency mortgage. Over the last 18 months, agency mortgage has a higher yield than corporate credit because corporate credit is so expensive. So the question is, why are you going to buy a corporate credit bond that pays you less and has more risk than buying an agency mortgage? So as you can see, our PIMCO income fund, if you look at the fact sheet, around 30% of the fund is agency mortgages today. And that's why it's, again, no credit risk, and it pays you better than a corporate bond. So for us, that's the biggest opportunity out there. And hopefully, investors can take advantage of that.
Interesting. We don't hear much about agency mortgage-backed securities generally, but it sounds really interesting. Pretty interesting from a valuation standpoint. So Colin, what do you think of what Nick and Marcio have said? Any points you want to highlight, agree or disagree?
Right, I don't think the speakers brought up an interesting point to be selective in peaking yield in this kind of lower interest rate environment. And as our panel title suggests, these are strategies in peaking yield in the lower rate environment. So in this environment, generally, we are also more selective in iFAST. So when it comes to looking at credits, we like investment grade credits still. And this is something that we have echoed in previous years. So I think the key point here I want to highlight here is that despite the yields, despite rate cuts, we still think that yields are still broadly attractive within this space. If you look at the index level, we are looking at about mid 4% and above. And if you are being selective and peaking investment grade bonds around a 5-year tenor, US dollar investment grade bonds, you can still get a high 4s or even above 5% for certain bonds. So within this space, we are also more selective. We like, there are some opportunities we see in emerging market investment grade bonds, especially in the Latin America region, as also in European banks. So these are areas where we see provide us with a slightly better yield. But most importantly, issuers there are still generally safe. And across the board, we'll notice that investment grade issuers are still generally very healthy, which is the first thing when we looked at when we want to be selective in an environment where global growth is slowing. So when we look at leverage ratios, interest coverage, as well as a revenue trend, they are still broadly positive and they are still broadly holding up fine, no matter over the past few months, despite all the trade uncertainties and global growth slowing. So this is where we see opportunities in the credit space. But I also want to highlight that within the high yield space, while yields are high on the absolute level, I think investors have to be selective when it comes to picking issuers. Like what Nick said, don't overreach for yields, especially for lower credit issuers. And in this climate, really, with spreads being very tight, there is a really very little credit differentiation here. So you might get only a few or very unattractive yield pickup if you were to go down the credit rating ladder, unless you go very far down, like the double Bs or triple C space, where the risk is significantly bigger. So you're not getting that compensation as compared to times where spreads are a bit more towards the normalized level. So our message for investors when it comes to high yield bonds is to be selective and look at issuers that have a stable or improving credit profile, which is what gives us comfort.
Interesting. So I guess there's some differences in views. Some prefer your higher quality credit. Some prefer your agency mortgage-backed securities. But I think the lesson is, if you're selective, there's still pretty good yielding bonds available at decent prices as well. So moving to something more general. So there have been a number of topics, but a more general question, I guess, is what do you think markets are underpricing today in 2026? Or what do you think is like the biggest risk for bond markets today? Maybe I'll start with Nick.
Yeah, thanks. So I think whenever people say about underpricing risk, essentially people have the left tail at hand, right? They're thinking, what will cause me to lose money? But actually, when you invest as a manager, you're thinking about both options, right? What can go well that actually also helps me to make money? And I think at the moment, we are definitely paying more attention on that left tail, as I think many of you are, just given where valuations are at, right? Things are tight. Doesn't take much to go wrong for things to re-rate higher. And what we actually do think the risk is I recall the narrative just a couple of months ago is how many more cuts are we going to get, right? Why is that a guarantee, right? Is my question. Like, they don't have to cut rates even as much as Donald Trump wants it. So I think that the risk is that the rates don't actually get cut this year, depending on how the entire scenario plays out, because everything is priced off what the US Treasury curve actually does. So that's the one thing I'll pay very close attention to, because there are a lot of moving parts there right now, and it's very hard to predict with a lot of certainty.
Okay, interesting. So that was about the Fed. So Marcio, what do you think?
So going back to high yield, the lower quality part of fixed income, high yield bonds, we think that high yield is being priced for perfection. And if you have any volatility in the equity market, if you have any geopolitical tension, if you have a slowdown of the US economy, you might see some of these companies struggling. And you will see spreads widen and bond prices going down. So I think high yield right now for us is the area that we're trying to avoid. We don't think you're getting compensated for the risk in high yield. high yield has a very high correlation to the equity markets. So if you have volatility in the equity market, you're going to have volatility in the high yield market. But as I mentioned before, because it's so expensive, you're not getting paid for that. So again, it's an area that we are looking very carefully, and most of our portfolio, we're avoiding just the generic high yield bonds right now.
Yeah, thank you. So some different risks here, one on high yield markets and one on the Fed. So I think we've talked quite a bit about the Fed and what's going on in the US. So perhaps moving away from the US, Marcio, what are your thoughts on non-USD bond markets, perhaps Euro or emerging markets?
Yeah, so I think we're in a very interesting time where U.S. rates are very high, right? U.S. rates, over the last 3 years has been significantly high. And, U.S. bonds still, they're very high quality. So I think we came from an era, if you think about even Chinese bonds or Chinese rates, it always used to be higher than the U.S. And over the last few years, U.S. rates has been higher. So we do like the U.S. Because of that. Other countries that I mentioned are countries that the government will be cutting faster than the Fed. I mentioned the UK. Again, I mentioned Australia over the last few years are places we like. And then in the EM, as I mentioned before, looking at places where you have very high interest rates. Again, Brazil, Mexico. We also like the quasi-sovereigns, which are related to the government. Nick mentioned Pemex and Mexico. But you have those equivalents in other emerging market countries as well.
Okay, lots of countries, again, UK, Australia, Brazil, Mexico. Nick, what do you think of non-USD bonds?
Yeah, so I think in Europe, you also need to pay close attention to what's happened because of what Trump's done with NATO. So for just a refresher, if we've seen what's happened in Germany, for the first time in many years, they are actually spending money because they have to build up their defenses, just given everything that's the dynamic around Ukraine and Russia, right? So that can potentially cause an upward revision of German yields. And in Europe, most would expect German yields to have the lowest rate. So this is something we are paying very close attention to, because then that would have impact on non-German bonds in the rest of the EU. I think a lot of what we mentioned earlier already, like New Zealand, that's where we are seeing the economy being weaker. We much prefer investing there. And in our multi-sector portfolios, you'll see that a large chunk of our duration exposure comes from countries outside the US for the very same reasons that we mentioned earlier.
Okay, interesting. So again, lots of countries outside the US. Colin, I guess we can bring it closer to home. What are your thoughts on Sing dollar bonds this year?
Right. In fact, I feel that if you look at the Singapore dollar bond space, despite all the tariffs and all that kind of stuff, in fact, Singapore dollar bonds have surprised quite positively, have even held up quite well. So if you look at the Singapore dollar corporate bonds, for example, they have returned on aggregate about 7% last year, which is beating a lot of Asian bond markets. And what's more impressive is the plain vanilla AAA rated Singapore government bonds in general have returned about 8%, even higher. So across the space, we see resilience and we see Singapore bonds holding up pretty well. So in 2026, when we look at interest rates here in Singapore, we do think that it will remain low. But the issue here is there are a lot of the short-term yields have fallen significantly last year, and we don't see a lot of room for that to go. So this also means that investing in for sovereign bonds, Singapore dollar sovereign bonds, investing in short-term bonds feels like a bit like putting cash in a drawer. It is very safe, but it's not very rewarding. So where we see opportunities now is further out in the curve. So in the medium-term bond segment, which is around the 5-year SGX for government bond yields, which gives you a nice yield pickup of around 75 basis point plus minus if you compare that against Singapore Treasury bills at this point in time. But moving our attention to corporate bonds, so bonds issued by companies. So for Singapore dollar corporate bonds, we still think it is a good hold-to-maturity investment. So for investors who have bought in when yields are higher, they get to sit back and enjoy those attractive level of coupon. But for newer investors, they can still get quite a decent yield pickup over the Singapore government bond yields. So for example, if you look at the 5-year tenor of SGD corporate bonds, they still provide roughly around 80 to 100 basis point of yield pickup versus the Singapore dollar government bond equivalent. So in that aspect where we see opportunities are. For banks, we still like tier 2 bank bonds. We still find that there is value in tier 2 bank bonds. But on the other end, for non-banks, we still prefer issuers that are more stable, that have an improving credit profile and are providing higher yield generally than peers. So these are mostly within the real estate and property developer space.
Okay, yeah, there's been a lot of great views on US, outside the US, emerging markets, and finally back in Singapore. Before I let the three of you go, I just want all three to give a summary in one sentence only. What is the single message you want everyone here to remember from this panel? We'll start with Colin.
All right, I feel that this year is all about fine-tuning and small steps instead of making big steps. So when yields are falling, investors tend to overreach and allocate heavily, especially in lower quality bonds. But investors should always think back and really look at what you should be investing in. So go for higher quality, more durable income, and also consider funds that maybe have a laddered approach or an actively managed bond funds, for example, that reduces the reinvestment risk, especially when the coupons reset lower in this lower yield environment.
Okay, Nick.
4 things: stay global, stay nimble, stay selective, and stay invested.
Okay, Marcio.
Yes, so maybe just a couple of thoughts. The first one is cash rates has come down a lot. So fixed term deposit, which used to pay you 3% in Sing dollar or 5% in US dollar, they come down a lot. But high quality fixed income is still paying you anywhere between 6 to 7%. So it's time to lock in that yield. So time to really move your money from cash, government bonds to fixed income, because fixed income is paying you 6 to 7%. And as the Fed cuts, you're gonna lose that opportunity to lock in that yield if you wait too long. So act on your fixed income portfolio. And the second one is, as I mentioned in my presentation earlier, this should be a good year for both stocks and bonds. So a balanced portfolio of stocks and bonds should do well this year. So if you have a little bit more risk appetite, not just in fixed income, considering adding a 60-40 as well, and you're potentially gonna get some upside there.
Okay, thank you very much to the three of you for joining us. And yeah, with that, that's the end of the panel.